Hello, everyone. Hey, it's good to be here. It's so interesting, isn't it, that compared to the last presentation, um, we are up 67%. Back then in August, the price was $26,000. Right now, we're at 43,000. So yeah, we have a lot of ground to cover. It's not going to be only Bitcoin. I want to talk global macro as well. I have a whole bunch of charts to show you. And the title for this piece, "It's All Priced In, or Is It?" Came from just earlier this week, actually. There was this Belgian newspaper, like the Financial Times of Belgium, if you will, and they came out with an article that claimed, based on anonymous experts of the sector, that Bitcoin's halving and the ETFs are now excessively priced in. So I thought that was quite amusing. Also, that they didn't even mention who those, supposed experts were. So yeah, let's just explore that thesis. Like, is it really priced in, all these events that are going to happen over the next few months, or even in the coming week, if you're talking about the ETFs? So yeah, without further ado, let's dive in. And I'm going to do global macro first, and then we'll switch over to Bitcoin. So one claim that you see everywhere is that, are we going to have a soft landing? Is the soft landing here? Are we going to have a recession? And that's, of course, talking about mainly U.S. stock markets, but as everyone knows, that always reverberates throughout the world. So let's, give this claim a little bit of benefit of the doubt and say, like, all right, well, based on what could we argue that 2024 is going to produce a soft landing for the economy? There is the elections. Almost always when there's an election year, the stock markets get pumped up, and it's of course, because the White House tends to have political influence on the central bank, and so they are able to kind of push towards a softer policy. So we'll talk about that too. Just looking at the stock markets, like here's the world stock market index. It looks fine. Like, it doesn't look like anything's wrong with it. Not really excessively priced. Of course, it's a parabolic uptrend, which is worrisome because of what's happening with the money. But a lot of analysts think, like, oh yeah, why couldn't we have another great year? Saying, like, this is the German stock market index, looks quite healthy from a superficial point of view. And commodities have been kind of softening. Like, we had that massive rally in commodities, which fueled so much of the inflation, 2020, 2021, even it kept going in 2022. And then it's been going sideways. And so that, that's why I put it here in big letters. Disinflation is what policymakers want to tell you is happening. It's like, well, technically the inflation is not really reversing. We're not seeing deflation, but, there is disinflation happening. But so there's also another side to that coin, or that argument. Like, yeah, we are going to have a soft landing. Like, could this be wishful thinking? I think it really might be. I looked up the Google trend results for literally soft landing. This is going back to 2004. And right now we're peaking. Like, this word is being thrown around everywhere in the media, and is searched for, of course, because it's what people want. But we saw this peak back here, which, interestingly enough, was actually May 2008. So it was before the big crash in 2008 that search results, searches for soft landing, actually peaked. So it's really no guarantee. It could just be wishful thinking. So let's look at a bit more data and kind of like pull it apart, because the markets right now are not homogeneous at all. Everything is not going to go up or down in lockstep. Like, we're seeing more and more decoupling of asset classes. And I think that's the most important thing to keep in mind. So let's look at kind of the foundations of what's going on, especially in the US, but in many Western nations as well. Here's a quote from Jeffrey Gundlach. He's a known hedge fund manager, just a few days ago. So he said, since 2015, the U.S. economy has been running a rising deficit with close to full employment. This is unprecedented. So we have a debt-based economic scheme. The deficit as percentage of GDP is running above 6%. People say this is a good economy, But if we actually ran a balanced budget, GDP would be negative over the last 12 months. We cannot go on with this deficit-based scheme. But basically what he's saying is that we're living on borrowed time. The only reason why unemployment isn't much higher than it is now is just because the government is pumping subsidies in the economy that it cannot afford. It's just going into deficit, and money has to be printed to fill that deficit. And of course, we all know interest rates are the highest they've been in decades. So the costs, we'll talk about that later in this presentation, but the cost to even just pay the interest is skyrocketing. So this is completely unsustainable. And so there is a disconnect between what the public feels and believes and what the so-called data is telling us. And that data is, of course, Keynesian-based. It's very kind of superficial and biased, in my opinion, and the kind of indicators it looks at. And historically, it did quite a good job at kind of following the public opinion. But now, since 2020, there's a massive chasm between those two. So you can see that here in the graph. People's confidence in the economy is close to the lowest ever. And but the indicators, and that's why the pundits and the radio and the White House, everybody's saying everything should be fine. We have full employment. What's the problem? But one of the problems is, of course, the interest rates, and people have racked up a lot of debt in those low inflation, low interest rate years. But now we're seeing, and this graph is showing, what people have to spend as a percentage of their disposable income just to kind of pay the interest on their debt. And so we're seeing a similar shift as what happened in the 1980s. Like that was the driver of a lot of the problems in the 80s, is that interest rates went sky high, and so people's payments obligations went up. And so that means that the real economy is hurting. Also keep in mind, bond markets are still in a massive bear market. I showed, I think, this graph 3 months ago as well. I just want to remind everyone, this is global bonds corrected for official inflation, so for CPI inflation. And if you actually were to look at the real numbers, real inflation, it would be even lower. But yeah, to put this in perspective, this bond market crash, this is the largest crash since the foundation of the United States. Like this is, completely unprecedented in over 300 years. So the government debt obligations are crashing. That means, at least in my opinion, that has to mean that bailouts are coming, because central bankers are very keen to repeat over and over, there's no way for the US government to go bankrupt. There's always more money. We can always print more. And so that to me is a really important part of what's coming. And it's not just the US. Like here is a very long-term chart that shows the UK going back 300 years, and Canada and Australia, and they all are having these epic historic bond crashes right now. And to kind of give an idea about where that might lead, like why this is so bad, like if a government bond market really crashes even more, you're looking at, I bet a lot of you already guessed, like just before the year 1800 in France, that's the French Revolution, right? So that was the hyperinflation just before the French Revolution. And that rent chasm down there in the 1920s, that is Weimar Germany. So, and of course, these are crashes where the bond market goes down 75% instead of 25. But it's really, these are very precarious times. So I feel that's important to emphasize, because business as usual, it's not. It's no longer business as usual in the investing world. There's giant shifts happening. So briefly, let's also discuss real estate, because real estate really has been a piggy bank for generations of people now, especially the boomer generation, as like a store of value. And it's understandable, because the value of the money keeps going down and you can get cheap mortgages. And so it is just one way to build some wealth and protect yourself from inflation. But I've been saying over and over that this story is coming to an end. Like in dollar terms, real estate might still go up, but when you actually express it in hard assets, which we're going to look at, commodities, then real estate actually looks very weak. So for example, here is an index from Fidelity, the mortgage-backed securities. In the background there, you see the dollar-denominated chart, which, doesn't look too terrible. It doesn't look healthy, but it doesn't look too terrible. But then when you look at the commodity-denominated chart in the foreground, well, that's just been going sideways since 2009. Like you haven't made any money. It's just been flat since 2009, and it's looking like it's going to break down again. So that's just mortgage-backed securities. These are the houses themselves, the real estate index. And, we've had so much new construction since the year 2007, 2008. The quality of the construction has gone down. And yet, if you look at, the commodity expressed value of real estate, it has gone up almost by a factor of 10. I think it's like a factor of 7 thereabouts. And so that is just completely unsustainable. That, why do you have to pay 7 times more corn or 7 times more oil for the same house that's made out of kind of cardboard and sticks, oftentimes, and stone, you could say. But these are, real estate at the core is a consumer product. It decays. It needs constant reinvestment to be upkept. It's not a natural saver. It doesn't naturally preserve value. The only reason why there's been a multi-decade long bull market in it is because the money has been broken and people look at it as a backup. So we could see very significant retraces in real estate over the next few years. And so the recent tick up, which mainly is because of weakness in commodities, doesn't change anything about that. There's also knock-on effects, of course. So these mortgage-backed securities are sitting on the balance sheet of banks, and what you can see here is that especially smaller banks have massive amounts of these mortgage-backed debt obligations, and so they're in trouble, and they will need bailouts. There's no doubt about that. And so, in my opinion, I think we talked about it last time about the bank runs that were happening and the bailouts that happened recently in the U.S. Like some of the biggest bailouts, not just since 2008, but basically the bailouts are of the same size as what happened in 2008. So we have this ongoing, simmering forest fire that is just not stopping. Like the crisis in banking is ongoing. China, I just want to touch briefly because people often think like, oh, maybe the grass is greener elsewhere. Like, let's not over dramatize things. But there's a lot of instability in the East, in Asia, and China's economy is really not healthy, in my opinion. So just to give a quick idea, there's of course a lot more data you could pull to substantiate that and look at the debt ratios and such. But yeah, here's Chinese stocks denominated in U.S. stocks. So clearly, U.S. stocks are just pummeling China stocks. It's not even funny. And here is Chinese stocks expressed in commodities, kind of like a sideways story. But I mean, keep in mind, these are logarithmic charts. So when things go down, it gets really, really ugly. And technically, it's already breaking down from that upwards channel. And that's going to be a theme for this presentation as well. Like that channel that was bullish for a long time now is absolutely breaking down against commodities. So again, like I said earlier, I don't think this is business as usual anymore. And so we are going to see heroes fall off their pedestals. And I believe it's already starting. For example, Carl Icahn, the stock market legend, who was always very, very outspoken, very, very bold in his moves. But I believe that he was also quite reliant on that low debt, low interest rate environment. And so ever since last year, 2023, he's gotten really in trouble, and his stock is down significantly, even in dollar terms. Here is his company expressed in commodity terms. Like, that's a downfall. All right, to me, that's just a downfall. Even companies like Netflix that people think are healthy or are maybe a good bet for the coming decade. Of course, it's been an absolutely mind-boggling ascent to the past 10, 15 years, but they as well, they've fallen out of that channel, and are likely going to break down more against commodities. Here's Apple. Like, again, it's just every time it's that parabolic uptrend that gets broken. Yeah, Warren Buffett is still okay for now. Like that channel has not been broken, but you know, names like that I expect to not do well. Of course, he's more invested in basic services than some of these other stocks that I showed. So he's a bit more insulated, of course. But even so, you know, like we're talking about a massive undervaluation of commodities, like very simple things like farming and energy production, those kind of things, as opposed to consumer-based America. And so here's another, you know, gives an idea of what I'm talking about. This is the NASDAQ expressed in commodities, like just a very clear breakdown of an unsustainable trend. This is literally reality's hitting, right? I mean, commodities are tangible assets that are scarce, and that's kind of running into this this wall of that wealth without end, like this illusionary wealth. I've been rewatching the HBO comedy series Silicon Valley, and at the time, like, we thought it was funny. Like, this is what is it now? It was before the pandemic that it came out, maybe 2018-ish. We thought it was funny, but like if you look at it now, it's like really looks like a documentary, and really like documented some of these excesses of Silicon Valley and the world at large. So this is something that I wanted to show you to again illustrate how there has been massive underinvestments in the commodity sector, and that money was shifted away. Those resources were shifted away towards consumer companies because of all these interventions in the financial world. So, for example, here you see the capex that was done in the technology sector versus capex in the energy sector. So that has to switch. That is just completely unsustainable. So inflation, it's important to mention, especially because, you know, the refrain in the media and on the radio is that, oh, everything is disinflationary now, we're fine. No, we're not. We're not fine. So again, I use this to also remind myself, inflation is very much a nonlinear phenomenon. This quote from Germany, or about Germany in 1920, like literally just 2 years before hyperinflation, the exchange rate of the mark against the dollar and other currencies actually rose for a time, and the mark was momentarily the strongest currency in the world. So let's not fool ourselves, you know, that these temporary rallies in the dollar and other fiat currencies are sustainable. Here's another parallel with the 1970s. What you see is in blue, you see the inflation of the 1970s, and then mapped against that is what we've seen recently with the dollar. So we're in that lull phase now, and we're going to have another. It's just a matter of when we're going to have another big run up in inflation. So this is probably the most important slide of this presentation, at least as far as global macro is concerned. So right now, this is also from Jeffrey Gundlach's presentation. So right now we are at 6% interest, and what you're seeing here, interest rates, what you're seeing here are projections based on how the interest rate could change in terms of what percentage the government needs to pay just to keep up with its interest payments. And I'm talking about percentage of tax revenue. 100% is halfway this chart pretty much. So if interest rates go to 9%, then the government will have to default by 2030 because literally 100% of its tax revenues are going to be absorbed by just paying interest. That's the definition of bankruptcy. If the interest rates stay at where they are now at around 6%, then by 2029, 60% of tax revenues are going to go to interest payments. So right now we're at around, I believe it's like 20%, which is on par. No, it's lower, but it's on par with the military budget of the US. Like that's how much money is being paid just to keep up with interest payments. So that's why people who think that we're going to go into a recession, a deflationary recession like 2008, in my opinion, that is madness. That is impossible. Yes, we can have a brief crash, but a protracted bear market, which means a bull market for the dollar, that I believe is impossible at this point. Of course, the Fed, we talked about the elections. So not surprisingly, is all of a sudden turning dovish. So December 2013, they came out with a press conference, and the Chairman Powell said, "We believe that we are likely at or near the peak rate for this cycle." So basically, they're not going to raise interest rates anymore. They're, and usually interest rates aren't kept flat for a very long time. That probably means he's thinking about lowering them. And if we look globally, interest rate cuts that have already happened at central banks, globally speaking, they have been cutting interest rates. It actually started in 2023 already, and it's just accelerating now. So easing is already happening. Reflation is already on the way. And Bitcoin responds to that. Bitcoin responds to money printing. We'll see it in another slide. Bitcoin responds to money printing, if anything. It doesn't really, it's kind of smart. It's really smart. It doesn't really look at the official inflation rate or prices in the supermarket. It knows that the origin of inflation is the money printing. And so smart money looks at that and just buys more Bitcoin when that's the case. I threw this in here again, just as a reminder. The 1970s was stagflation, just like now. It's probably going to be worse now, but the asset classes that did very well were scarce assets that had low third-party risk, such as gold and commodities, and value companies did better than growth companies. And the worst was, of course, government bonds and such. So let's talk about Bitcoin. So one refrain, like I said in that newspaper article, that we keep hearing is that the Bitcoin ETF and the halving are priced in. And then I wonder, how is that possible if nobody even searches for Bitcoin or how to buy Bitcoin? Like, the global Google searches for buy Bitcoin are the lowest since December 2019. So pre-Michael Saylor, pre-MicroStrategy, pre-all of that. So to me, this is just, in the eyes of the world, we're still in a bear market, even though, yes, we actually are up 67%, but the world is not paying attention yet. Bitcoin OGs, I mean, people that have old Bitcoin and that control a lot of the old Bitcoin that hasn't moved in a long time are still completely unfazed. So what you see here is the hodler position change. So the green means that hodlers are just sitting tight, they're not budging. And the red means that they are actually moving their coins, which usually means selling. And so, yeah, OGs usually sell into strength. They sell kind of at the right time. And right now, there's just no sign whatsoever of selling. So that's very encouraging. Also, net unrealized profit loss. This is from Glassnode as well. Basically, you take all the Bitcoin in the aggregate and you calculate for every Bitcoin, is it looking at unrealized profits or looking at unrealized losses? And so based on that, you can, in the aggregate, gauge market sentiment. And usually Bitcoin tends to start selling off when more than 75% of the entire market is looking at unrealized profits, because that's often when greed kicks in. Right now, we're at barely 50%. So that sentiment has switched from kind of optimism, anxiety to more like belief. There's more confidence in the market now. But definitely, I believe we're not at exuberance or euphoria. The halving is something that is coming. We're very close now, only 90 days away from Bitcoin supply being cut in half. Sorry, I guess I showed this chart because every time you can see this run up ahead of the halving and then into, after the halving as well. So I think that's coming again. Just to summarize it for you, the daily supply is going to drop from 900 Bitcoin to 450 Bitcoin. That means 20 million a day less of supply in Bitcoin. 7.3 billion a year at current prices, less available supply in the market. So that really is significant tightening. The annual inflation of Bitcoin is going to drop below that of gold. So it's going to drop from 1.6% to 0.8% per year. So I think, that's significant. It's kind of like, it means Bitcoin is harder money than gold, even though it always was, but at least now it's becoming reality. So yeah, is it going to get approved? Are we going to see an SEC approval of the Bitcoin ETFs? It really does look like it this time. Like, I was jaded for a long time. One of the first and major things that convinced me that this time is different is just seeing the advertising dollars that firms are spending to pre-promote their Bitcoin ETFs, because they're all going to be competing if they are approved. I feel like they would only really spend those big dollars if they are actually confident that they'll get approved this time. And some of these funds have been applying for 5, 6, 7, 8 years, and only now the big commercials are coming out. Also, the betting markets are giving it 81% chance that the Bitcoin ETF will be approved by January 15. And actually, you could argue that the betting market is going to skew a bit more bearish than what people really think, because if you're really optimistic and you would vote in favor of this, well, you would rather invest just buy Bitcoin than to try and make a paltry return, right? Where the market is already pricing in 81% success rate. This is nitty gritty really, but if you really want to talk about whether you should sell the news, well, I agree with Alex that you have to look at the actual launch of these products rather than the approval of the products. So just something to keep in mind if there's any traders out there. I'm personally not going to trade on this. Also, what I think I heard is that there's actually probably a very small gap between approval and actual launch, but that remains to be seen. Yeah, so I think this is like a big theme that's coming, right? Everybody needs a Bitcoin strategy. And then, of course, an approval of a Bitcoin ETF will make it so much easier for anyone to just pick up the phone and say, put 5% in Bitcoin. It takes 5 minutes. And also hedge funds and pension funds, and I mean, you name it, they can all just expose themselves to Bitcoin and have that like sweet extra alpha. Because if you do a simulation of a 60-40 portfolio or any kind of vanilla portfolio, and you add just 1% Bitcoin or 5% Bitcoin, and you look at that simulation, the outperformance of your portfolio is just massive, even if you take into account rebalancing and things like that. So yeah, it's coming. Bitcoin versus the NASDAQ, like, to me, again, this indicates that a big move is coming. Bitcoin broke out against the NASDAQ decisively, and in the past, it made really epic moves after that. So that's what I'm expecting. Here's the Bitcoin price expressed in units of global bonds. So it just looks very healthy, and it has a lot of room to move to the upside of that channel. So it's, of course, an excellent hedge for anyone who's exposed to bonds to get some Bitcoin exposure, which, the insurance sector could make that kind of could go and buy into that logic and therefore start to expose themselves a lot more to Bitcoin. Like I said earlier, Bitcoin really responds to money printing. So this is a great chart from Raoul Pal, where he created an index for global M2. Like, M2 is pretty much the most accepted metric for central bank money supply. And so you see that go up and down, like not that the supply ever goes down, but the speed of new money generation, that's what you're seeing, the change year on year. So as we go into another upswing of that global M2, clearly Bitcoin is really wanting to follow that. So that's just, to me, the big question is just, are we going to have money printing? And if yes, that just means massive win in the sales for Bitcoin. So one thing I did want to touch on briefly, and this is really the last part of this presentation, is this idea of a speculative attack, and specifically a Bitcoin-fueled speculative attack. I'm going to let Pierre Rochard say a word about this, because he wrote a fantastic article back in 2014, so 10 years ago, about how Bitcoin will be used as a way to speculatively attack weaker assets, especially weaker fiat currencies. So Pierre said, a speculative attack that seems isolated to one or a few weak currencies, but causes the purchasing power of Bitcoin to go up dramatically, will rapidly turn into a contagion. The feedback loop between fiat inflation and Bitcoin deflation will throw the world into full hyper-Bitcoinization. Sorry, those are a lot of new words maybe, but basically the mechanism he's describing is similar to what George Soros did in 1992, when, you know, he's famous for the man who broke the Bank of England, is you know, often the moniker that they give him, George Soros, because what he did was he saw that there was structural weakness in the British pound, and he took his large dollar-based position, went to the bank, got a massive loan, and used that to short the British pound and made a killing. Absolutely made over $1 billion. I forget the exact number, but that was a lot of money in 1992. And so that's the mechanism, right? You have a hard asset, a really strong asset that you can leverage, and you borrow against that, and then using that borrowed money, you sell the weak asset, and therefore you create selling pressure in the market. And so, yeah, the Michael Saylor has been doing that, where the hard asset is MicroStrategy stock, which is now more and more backed by the Bitcoin in their balance sheet, borrows against that, and then what does he short? He buys more Bitcoin, so he shorts the dollar against Bitcoin. That is the strategy. So that's that speculative attack. It's now being shown. And what's interesting is that we're entering now a new phase, because what MicroStrategy is doing is not only are they borrowing to then use, you know, short the dollar with that borrowed money, they're actually shorting the stock markets as a whole, because what they're doing is, instead of borrowing more money, they're just issuing more shares and then selling those shares into the market, using the revenue to buy more Bitcoin. And so I'm going to let Preston Pish explain it. He did it really well just a few days ago. He says, globally, price to earnings is grossly mispriced. So let's say PE is at around 30 right now. Say on a Bitcoin standard, it will go down to 10 because people have been, remember, people have been using the stock market as a piggy bank. And as the need for that reduces, well, the price to earnings ratio should go back to historic levels, back down. So that's what he's saying. It will be down to 10. So that means you need a 66% reduction from current equity premiums to manifest itself into this new world, which means you should be a seller of common stock. Even the companies themselves, right? They should be selling their own stock until it gets to those low PE ratios if you are denominating your treasuries and your free cash flows into Bitcoin. So if you think on a Bitcoin standard, that is the logical thing to do. He says for the companies that are not doing that, the PE ratio even has further to fall. It makes sense, right? Because their treasury is going to evaporate. Their cash flow is going to get hurt more and more as the inflation increases. He says this is a really big idea that I think is lost on nearly everybody. And I agree. Like this was lost on me too. It really is a massive thing that harkens back to what Pierre Rochard was talking about back in 2014. So where are we in the U.S. stock markets? Shiller PE, which is corrected for inflation, right now is at 31 for U.S. stocks. And so you could say like, oh, but isn't that kind of okay still? Like, historically, maybe the average was 15, but like, aren't we in a new world? Well, I mean, think about it. Like early 1900s, PE ratio were very high, but like the U.S. was one of the fastest growing real economies in the world. Like there was, so much demand for stuff. And then that was before central banking. So that was the peak before central banking in a very healthy economy with almost no debt. And then in 1930, you had that massive run-up, which was clearly debt-fueled. Like, I mean, that was just the central bank had come to life. The gay 20s happened. Everybody was just spending like crazy. So, of course, PE ratios went to very, very high, unsustainable levels. And that was even those levels were the same as today. And of course, the economy wasn't in shambles as much as it is now. Like there was actually more real world economy to the pie than there is today. And then of course the run up in the 60s, that was that was also based on, or that was just assuming very, very low oil prices, which then changed into the 70s. And then, of course, we had the dot-com bubble. So, I mean, this is just another bubble. Like, in my opinion, this is completely unsustainable. Like we saw before, like the economy is not healthy. We're running on borrowed, or we're on borrowed time, really. So this has to come down. So I agree that a speculative attack using this PE ratio and for companies to issue more stock, sell it into the market, and use it to buy Bitcoin is a very strong potential and even likely tailwind for Bitcoin that very few people talk about. And again, it's literally been working for MicroStrategy. Here's how the amount of Bitcoin holdings per share has changed over time. And the last year, I believe they stopped issuing new debt, and they've mainly focused on doing that anti-dilutive stuff with their shares. So very successful, interesting strategy. So summarizing this whole presentation, U.S. election pump should be good for Bitcoin. Central banks absolutely have to print again. They have to bail out governments, bail out banks, bail out large corporations that are close to Wall Street. Bitcoin ETFs are most likely coming very soon. Massive catalyst, of course, if they come. The halving, in my opinion, is, the halving is certain. It's happening in 90 days. Bitcoin clearly responds to money printing, and it's also fueled by these speculative attacks. So yeah, I absolutely believe that there's going to be this wall of worry, like there's going to be particular, government crackdown concerns, all kinds of things that we will worry about, but that this is absolutely early days in the bull market, and Bitcoin will trade much, much higher by the end of 2024. So yeah, that's it for me. I'm happy to hear if there's any questions.
Thank you so much, Tuur. This was a fascinating presentation, and we got lots of really good questions. Before we move to the questions, I just wanted to do a disclaimer that everything we're saying here, both in Tuur's presentation and in the questions, is for entertainment purposes. It's not financial, tax, or legal advice, and it's the views expressed here are of Tuur in his individual capacity and do not represent necessarily the views of Unchained. Basically, don't consider them as investment advice. So with that out of the way, we got some really good questions. So let's start with this PE being too high idea. I've seen many people claim that, yeah, this is unsustainable. So I just want to play devil's advocate here. As I've heard a thesis that is not very commonly heard, but basically that these PE ratios are sustainable. And why are they sustainable? Because basically technology is becoming a larger and larger share of the GDP. And technology has a higher PE ratio than non-technology because, higher margins and higher growth rates and so forth. And so basically claiming that it went 3x from 1880, some people say that's not necessarily unsustainable, when we have robots and flying cars and all of that, probably the PE ratio of the stock market will be high. So what are your thoughts on that, Tuur?
The first thing that came to mind was this Bitcoin pragmatism of where does the yield come from? Because basically, if you break it down, the PE ratio, it's pretty simple. It's just you have a turnover, there's money that flows through your hands, and the market is going to give a value on your stock, on your company, based on how much money flows through your hands, because it assumes that a certain percentage of that you'll be able to capture and keep, which is your profits, and that can then flow back to investors via dividends and things like that, or stock purchases and stuff like that. And so in my opinion, a high PE ratio has this assumption of growth. It just assumes that markets are going to keep growing, and that in my opinion, just flies against all the evidence that we're seeing. Like, the markets are actually stagnating or shrinking. We have seen a lot of, luckily, growth in energy. For example, oil production is now at highs, very close to the all-time high, both for the world and definitely for the U.S. Actually, U.S. oil production is now double that of 2006. So that's just staggering, right? Because of the fracking and technology. So in that sense, like, yeah, they kind of have been able to grow the pie, but with more political tension, like as the world deglobalizes, that's really going to threaten that old model of, we don't need to keep large stores of our goods. We can just on the fly always order more. It's like, well, you can't do that if the Strait of Hormuz is being, if container ships are being rocketed and stuff. So just to me, there's a lot of assumptions that are baked into this high PE ratio. For example, think about a house. Like if you own a house and you can rent it out, like what should the price of the house be based on how much rent you can collect over a year? Should it be 50 times the annual rent, or should it be 100? I mean, like, as the neighborhood gets more dilapidated and people lose their jobs, and even if you're saying like, oh yeah, but the rent is slightly down, so that ratio has to adjust as well. It has to adjust to the world. There being more risks. You can have a catastrophic failure of the house. There can be a fire. You can have squatters come in. The police is not there. And so similarly here, like a PE ratio, like all these companies can also catastrophically fail. And I think those kind of things are absolutely not priced in.
Awesome. Thank you so much. Another question here. As someone who's covered technology in the media, I'm blown away by how many people will spend 50 hours digging into Apple's firmware code, won't spend 5 hours looking at Bitcoin. Why do you think some of the brightest technologies in the world are ignoring Bitcoin?
Yeah. And was this person talking about specific technologists or technology companies?
Technology media. So the idea is that, people who analyze technology will spend a lot of time going into the tiniest details about the competitive edge of this or that company, but they just don't spend a time looking at Bitcoin. And I can tell you, as someone who was 10 years in Silicon Valley overall was very anti-Bitcoin and pro other, crypto technologies.
Well, yeah. Alan Farrington has written a great piece about, I think, at least he mentions like the Capital Strip mine, and he talks about Silicon Valley as being kind of philosophically antithetical to Bitcoin, because Bitcoin is about low time preference. It's about investing in the future, like really taking your time with things. In so many ways, you can see that. And Silicon Valley, a big part of the growth has happened because of the consumer economy, like consumption focused. Like all these, like I said, like all that comedy series, like all those companies are very, very consumer focused. And so, yeah, it doesn't surprise me that also journalists and media who have a technology focus, quote unquote, are just kind of oblivious. They don't really understand economics. I forget, but it's just out of their wheelhouse. They just don't understand it. And it's kind of opposite, right? I mean, the success of Bitcoin is happening because this whole system that allowed them to grow so big is diminishing. And also, I mean, keep in mind, technology, why do we associate it with like Facebook and stuff like that? Like almost every company uses technology, like an oil driller uses cutting edge technology, somebody, so we always associate it with consumer goods, but tech doesn't have a monopoly on that. Tech is everywhere.
Yeah, that's a great point. I remember learning that the first autonomous vehicles were actually in mines, like in 2014 or something, because someone who owns the mine owns the whole land. So they don't need to they don't have like rules of the road and stuff. Cool. Next question. So you mentioned that the difference in the capex of energy and technology is unsustainable. What do you see happening if it actually changes? So if like we get more investment in energy.
Yeah. I mean, to me, that's exciting. Let me try and see if I can find back that slide, CapEx. Yeah, here it is. Yeah, basically, it's kind of a return to sanity, really. It's tough. It's kind of like what we see happen in Argentina now. Like, I mean, of course, it's very, very early days, but what Milei is doing is simply saying, "No hay plata," like there is no money. We just don't have the money to keep pumping things in the economy. So, for example, cultural subsidies are abolished. All kinds of subsidies are abolished, and so then the economy has to figure out, like, well, what is the priority? And so, rather than tax dollars being levied by the government going to subsidize actors who make movies that are consumer based, obviously, those dollars never are taxed in the first place. They stay with the consumer. People use them to put gas in their car, and then the oil company eventually has more money to invest and expand their capex and be proactive and expand capacity. So, I mean, in short, it just means that, yeah, we need a larger percentage of the economy to go to mineral exploration, to go to farming, to go to oil production, energy production, those kind of things. So yeah, it'll just be a more basic economy. Like, less people are going to have white collar jobs. More people are going to be, digging around on a farm or working in a factory or things like that. It's part of the rebalancing process.
Awesome. Next question is, what factors do you look for to understand whether Bitcoin is decoupling from other risk assets?
Yeah, whether Bitcoin is decoupling from other risk assets. Well, that's a loaded question, right? Because it assumes Bitcoin is a risk asset. But I think I know what they mean. Yeah, from a volatility point of view, or definitely like the correlation, right? Because Bitcoin has been assumed to go up and down we saw it with crypto, right? I mean, crypto, in my opinion, that's the real risk asset. And of course, it's been going up and down with the NASDAQ. So to me, that's actually a good one. The NASDAQ versus Bitcoin, the chart I showed earlier, that really shows that, yes, there is convergence and it can last for years, but then you have that massive decoupling, and that's happening right now.
Yeah, makes sense. So next question is, do you believe the insurance sector will be one of the primary beneficiaries of the ETF on-ramp?
It really could be. Yeah. I mean, I wish I was more versed, and I need to study it more in terms of what are more legal hurdles, because I do know, for example, in life insurance, there are just legally defined buckets. Like, you can only invest this much or that much of your entire portfolio into Bitcoin. But still, I think most of them are at 0%. So even I think the BIS even said that regular banks can now invest up to 2% or something in crypto, which includes Bitcoin. So yeah, I mean, until we hit those limits, maybe they don't matter that much. Yeah, I think the insurance sector is going to be very, very thirsty for an asset like Bitcoin, which in their view just diminishes risk. Like, you just add that little 1% at the tail, and it changes the risk profile of your entire portfolio. Because for years and decades, the assumption was, oh, bonds are the safe assets and cash, and that's completely out the window now.
Yeah, that makes perfect sense. Another question here is about a different version of the soft landing that people are talking about there, which is basically, if you print money, if you expand the money supply a couple percentage points more than the interest rates, you could inflate the debt away. So for example, if the interest rates are at 6% and you expand the money supply by like 8 or 9%, which is not that crazy compared to, previous, I believe I read overall that, like, if you take all the currencies in the world, the weighted average is around 8% increase per year. So like, could that be a scenario where there's nothing catastrophic is happening? So let's say 8% money supply increase will cause some inflation, but it won't be like crazy inflation, but it will be able to, just get rid of all the debt we currently have.
Yeah, I mean, that is kind of the hope of a lot of people, but I'm afraid that the inflation is already baked in. It's like a musical chairs situation where there's so many people in the room, and there's like 100 people in the room. There's only 5 chairs to sit on. Like, there's so many overlapping claims. Like, people, for example, people who have a 401k that's traditional 60/40, the real value of that might only be 20, even though they believe it's 100 now. Like, the purchasing power equivalent real value of that might only be 20. So they could be looking at, and we've seen that many times in Latin America, where all of a sudden people just lose it all. And so to me, how much money printing exactly is happening right now, like that is the flow part of the equation, and that's not looking at the stock. And the stock is, we have so much worthless paper in the world, and it's just a matter of time before people find out about that. And so, remember how crazy it was that we had negative interest rates on, negative yields, on government bonds. And yet people had loads and loads of these sitting in their portfolios. And that's changing. And so once you follow that cliff, you have a rush to the exits, and the value of this paper just evaporates. So I think it's maybe similar to, how we had these algorithmic stable coins, where it was like, yeah, but we can just kind of, toggle the levers enough, and like, we'll always like engineer our way out of the problem. That's kind of how I feel about this idea of like, oh, but what if we just print like just enough, but not too much to, yeah, of course we are going to print our way out of the inflation. That's going to happen, but I don't think you can do that in a soft way. It just never does, because 90% of people, or 95 or 98, does not even realize that the value of money could go down so fast. Like, that's what creates that gradually then suddenly effect, the run for the exit.
Yeah, that makes perfect sense. And maybe as the last question here, so we know as Bitcoiners that, we hold views that are not traditional, and, we make money because of that. I think it was Peter Thiel that said something like, the secret to making money is to be right when everybody else is wrong, and then like you can make money. But I was wondering if you have any view or anything that you see where you think most Bitcoiners get something wrong. So something that's like common within our circles, within Bitcoin Twitter, that you have a different opinion.
Oh yeah, well, I mean, for example, I haven't gotten involved in the whole debate about blockchain spam, like that, ordinals and BRC20 contracts, and it's all very technical sounding, but basically people are putting stuff on the blockchain that is technically just not a simple Bitcoin transaction, and it's taking a lot of room. And some of those things that they put on the blockchain, they can kind of put on it for cheap, like they pay less per byte than you would for a normal transaction. And so there's just a lot of drama around that and debate. And there's now a new mining pool that's based on Luke Jr.'s software, and Jack Dorsey endorses it as well, where you can like strip out some of those transactions and have like a cleaned up blockchain. And so it's just a minor thing, but I imagine if you're new to Bitcoin, maybe it looks like this big upheaval, and I just don't really worry about that, because the foundational the market is very good at ironing out those kinks, because the more, if a certain contract gets very popular, like the BRC20 contracts, I think like 80% of the blocks were occupied by that, and that's why the fees spiked to like $50 a transaction briefly. And the solution for high prices is high prices, so that means also those contracts get really expensive. And then people tend to back off, and they look for solutions on second layers. And I mean, people that have been in Bitcoin for a long time remember, for example, Eric Voorhees had this company called Satoshi Dice back in 2012, 13. And what they were doing was they had designed a little smart contract on the Bitcoin blockchain where you could gamble. So you could gamble on using Bitcoin. And you would kind of roll the dice, and then you had your odds 1 in 100 or 1 in 1,000 or 1 in 10. You could toggle the odds and get a payout. So that was all directly on the blockchain. And so people back then as well were upset, like, oh, this is bad and Bitcoin is going to be destroyed by this bad use. But eventually it just became too expensive for Satoshi dice to do that. And so gambling platforms moved into other areas. So I just see, there's just one thing that I see that I feel like the level of drama is not really justified by, and if anything, it's a good thing because fees are going up and people are now realizing like, oh, we need to be smarter about second layer and Lightning, and maybe Liquid is not a bad platform, and so we're seeing that it pushes resources into second layer development.
Awesome. I actually see some more questions that came in the chat, so I'll read them too. So the Nobel laureate winning theory, commonly known as efficient market theory, says that pure markets quickly absorb new information by adjusting up or down asset prices. Why Bitcoin isn't already trading above 100K or beyond? The only thing that troubles me is that Bitcoin doesn't always comport to efficient market theory. Either the theory is wrong or we are wrong. How do you reconcile Bitcoin's relatively low price at 43,500?
Yeah, I agree. It's a popular theory, but it's wrong in my opinion. And you can, if you're curious about some criticism of efficient market theory, I'd recommend Googling efficient market theory and Austrian School of Economics or something like that. Definitely Austrian economists have written about this. And it's just not true. I think especially Friedrich Hayek has written about how information spreads in society. And it's not like it gets airdropped onto everybody at the same time. Like information trickles slowly into the economy, and prices follow. Like people, their investing behavior is based on the information they have and the knowledge they have and the beliefs they have. And Bitcoin is very heretical. It really is kind of, it's financial blasphemy. It's a very challenging concept to get. It involves cryptography. It involves, economics. It involves computer science. And you have to kind of put all those pieces together to really grasp what it is. And it's just and also what I mean with heretical is that money is kind of binary, like, either you win or you don't. And so if Bitcoin really wins, it means that a lot of the fiat currencies are going to be very, very small in comparison. And so it's a very challenging concept for many reasons. There's also career risk involved. Like if you work for a fund, and a large fund, say billions of dollars, but you're just one of the analysts, then you can face career risk by really sticking your neck out and advocating for this. And then maybe you're a bit too excited and there's a 40% correction that you didn't see coming, and that could cost you your promotion, for example. So yeah, it's something that you learn in Bitcoin, is that no, absolutely, like that's why I put out my reports in the bear market, because the price gets so undervalued that you almost start questioning your own sanity. It's like, how can this be? Like this technology is so sound, and yet the world is saying it's only worth, back in 2020, $3,000 for a Bitcoin. That's just not right. So yeah, I mean, it's just like with science, right? I mean, there's a lot of things that can be very popularly believed that are just wrong. So it's the same with price.
Awesome. And maybe the last question here is, can you talk about KYC and non-KYC Bitcoin advantages, disadvantages? Also, can you talk about the importance or not of actually spending Bitcoin at this time? As a new resident of El Salvador, I face a lot of people passionate about using it. I feel more relaxed about the process, about BTC adoption happening organically. And also as a US citizen, with KYC BTC, I find it problematic, but I would like to hear your perspective.
Interesting. Yeah, so KYC stands for Know Your Customer. Most people don't deal with KYC that often in their life. Like you go through it once when you set up your brokerage account, maybe your bank account, and it's basically based on this idea that financial organizations need to know their customers so that they don't allow them to do nefarious things. Like basically, if you're a terrorist, you shouldn't get through the KYC process. But But of course, it means that your information now is in a database, and it could leak, and it means that, especially if you live in like a Brazil or a developing economy, if your personal information leaks and it gets linked to you having a certain financial status, then you could become a target for robberies and things like that. And then, of course, there's also the reasoning, especially hardened cypherpunks think this way, is that, you know, if we don't know how government is going to evolve in the future, even in the West, and so if I'm transparent about all my Bitcoin holdings, then it's easier for them to find and confiscate everything that I have. So that's kind of like the background. And so, but there's a flip side to that. There's, you know, you could say, okay, I'm going to only buy Bitcoins that are freshly mined by a friend of mine, and I'm going to pay cash. Then, okay, then you have that non-KYC Bitcoin, which is almost as good as, cash. That there's a challenge there, because then you cannot use that for example, use as collateral. If you want a loan from a bank, well, they're going to ask you to prove the source of funds. Like, how did you get those Bitcoin as part of their process? And so if you want to leverage Bitcoin, you can usually only really do that with KYC Bitcoin, with white Bitcoin. And there's also another element to the discussion, which is non-KYC Bitcoin. If you bought it, for example, I don't know, from a friend or something, there's these companies like Chainalysis who analyze the blockchain. If it's not coming from a very big company that you originally bought it from, it's more like an obscure exchange and it's somewhere in Europe or something in Russia, who knows, then that blockchain analysis might show red lights, like, oh, this is associated with money laundering. And even if you didn't do anything wrong, that money those Bitcoin can get flagged as like kind of tainted. And I mean, so anyway, for all those reasons, it's hard to give a general recommendation about that. I do think it's wise that if you live in a developing economy, to be very discreet about being a Bitcoiner or how many Bitcoin you have, and to try and avoid leaking information to especially local institutions. I think that's very wise. And then as far as these, you know, kind of more kind of, you know, things going bad in society type concerns, like what if the government goes after my coins? I would say, I mean, yeah, I mean, it's I'm definitely not against like people having a part of their Bitcoin in a very discreet way. And yeah, like one way to do that is to mine them directly. That's definitely a great way. Mine them directly, or have some kind of deal with a miner where because those are the most pristine Bitcoins. That's probably why I'm talking about this too, because you could try and find them from some guy who happens to have Bitcoin, but then you don't know if that is going to bring up flags from Chainalysis and stuff.
Awesome. Well, thank you so much, Tuur. This was a fantastic presentation. Thanks for everybody who asked questions. We unfortunately ran out of time, so we can't get to all of them. But, you know, the purpose of these signature events is really to give you guys access to the best thought leaders in Bitcoin, and so you can ask them questions. So thank you all. Tuur has a fantastic report called How to Position for the Next Bitcoin Boom, which was published, I believe, like in April, and it's still as relevant as ever. So you can Google it. It's on the Unchained website. And thanks again for everybody for coming and participating. And thank you, Tuur, for a fantastic presentation.
Thank you, everyone.